On today's episode, we are going to take a look at Johnson & Johnson's earnings. They just reported today for quarter one of 2020. So let's get started. All right, so the first thing we're going to take a look at is the stock performance. This company, for today, they reported earnings in the morning. It's up 4% due to the earnings. So we're going to see that earnings report were actually not as bad as what was expected. The company right now is sitting at $146, and compared from its all-time highs in February, this company is only down not even 5%. And I think that's pretty impressive, right? The overall market's still down close to 20%, maybe a little bit lower than that, with today's gains, maybe 15% down. So to have a company that's only 4%, 5% down compared to the overall market shows that there is true strength in this company. Before we begin, guys, don't forget to hit that thumbs up, subscribe to the channel. It helps the channel so much, and post on the comments. Let me know, do you guys think Johnson & Johnson did great earnings, or what did you guys think about the company's earnings? Make sure to post on the comments. I'm also streaming on Twitch and Mixer. The information should be here. And finally, I have a Discord group where I have some nice, great investors in there where we're just sharing ideas. So feel free to join. All the information will be in the pinned comments or in the description if you're listening to the podcast. All right, so first let's just take a look at how earnings did, and then we're going to take a look at some news article, and finally the information that they've provided to us during their earnings. So non-GAAP earnings per share were $2.30, and it was expected for them to have somewhere around $2. So it beat by 30 cents. And then they had GAAP earnings per share of $2.17, and it beat by 74 cents. So that's pretty good for them to have both non-GAAP earnings per share gains and GAAP earnings per share beat. Next, let's take a look at revenue. Revenue for this company was $20.7 billion. This company is pretty big to be making that kind of money, and it beat by $1.21 billion. So that's close to 5% beat. Pretty impressive. And then year-to-year comparison, this company, the revenue is up 3.3%. All right, so there's just two quick articles that we're going to take a look at before we take a look at the information. The first one is Johnson & Johnson is still increasing their dividends, and I think they've increased their dividends 25 years in a row, which is pretty impressive, showing the strength of this company. And I think it was a pretty bold move for this company to still increase their dividends here, because it shows, hey, we are a strong company and we have plenty of cash right now to be able to increase our dividends again. Even though they did increase their dividends, they did cut back a bit on their guidance, and we're going to take a look at that later on in this episode. The second piece of news that we're going to take a look at is Johnson & Johnson says that they can produce up to 900 million coronavirus vaccines doses by April of 2021, and that's obviously if trials go well. They're expected to start trials somewhere in September, and if everything goes as planned, by 2021 of April, they'll be able to have 900 million vaccines. So again, that's pretty good news, right? I think anything right now that shows, hey, coronavirus vaccine also drives the market up a bit. But remember, this is for April 2021, so a year from now, and this is assuming that they begin trials on humans on September, and everything goes well from there. All right, so next we're going to take a look at the slideshow this company provided during the earnings, and it gives a lot of information of what the company does and how it produces its revenue. So it's definitely great information. So first, like I mentioned, right, their earnings revenue for the first quarter were $20.7 billion, which was a 3.3% increase compared to the same time last year. And this is for the first quarter of 2020. Diluted earnings per share were $2.17, which was an increase by 56% compared to the same time last year. And adjusted diluted earnings per share were $2.03, which increased by 9.5%. So out of that $20.7 billion that I just mentioned, I'm going to break down what the revenue is. 3.6 billion of that revenue comes from worldwide consumer health sales. And this is pretty much over-the-counter stuff here. You have your Tylenol, your Listerine. They do have the mouthwash, Aveeno, Neutrogena, Pepcid. So a lot of over-the-counter items are in the worldwide consumer health. And that only makes up 3.6 billion. So that's a little less than 10%, closer to 8%. Over half of this company's total revenue comes from worldwide pharmaceutical sales. Worldwide pharmaceutical sales makes $11.1 billion of that 20 billion. And here's where you have all your pharmaceutical prescription drugs, Stelara, some other one, I think that's the only one I know, but all of their main drugs are here. One thing I forgot to mention, right, this the worldwide consumer health sales increased 9.2% year to year, so they are seeing strong increase there. In the worldwide pharmaceutical sales, they're seeing an increase of 8.7, so that's pretty impressive, right? They're seeing increase in both the over-the-counter medicines and also the pharmaceutical medicines. The final product is the worldwide medical sales, and here's where they have different types of items for the medical world, being wound closure, dealing with hips, with trauma, with knees, with spine, surgical visions. So that right there makes up $5.9 billion of the 20.7, so close to 25% of total revenue. A little bit over comes from worldwide medical sales. Unfortunately, right now they have seen a sale decrease of this by 8.2. One of the main reasons they do say that they've seen this decrease is because of the coronavirus, a lot less surgeries are being done that are not related to COVID-19. Right now, most hospitals are really focused on COVID-19, and unless it is a mandatory surgery, it's not really going to happen at the moment. So obviously they're going to see a decrease in those items. As well as people staying home has helped out with less accidents. So here they have, earlier in the episode, I talked about that they're planning to have a vaccine by Q1 of 2021. They mentioned April, and here they pretty much just have a timeline of how that goes. And I thought it was pretty cool to share. In March 30th of 2020, they finally found like the lead vaccine candidate. By Q2 of 2020, they expect to transfer of that master seed and start pre-manufacturing. By Q3 of 2020, that's when in September of 2020, they want to start their first human studies. By Q4 of 2020, they're gonna, which is December, they want to start collecting data. And actually, I think that's pretty crazy. Such a short amount of time. In 3 months, it only takes them 3 months to collect data. So I think that's, in my mind, right, I don't know much about the medicine world, but in my opinion, only 3 months of data, I feel like, is such a limited amount of data information for any long-term effects that the medicine could have. Just saying, again, not a medical expert, so I wouldn't know. And finally, they say by Q1 of 2021, they expect to have their first batches. And obviously, this is all if everything goes according to plan. So if they have a slowdown somewhere else, obviously the timeline is going to be expanded. Next, I wanted to take a look at the quarter sales and how they went throughout the region. So previously we saw how they were through devices or through the segments. We saw 3 segments. They also have they have 2 main segments when they talk about revenue worldwide. First, they have the United States, and then they have international. And when we talk about international, they have Europe, they have the Western Hemisphere, which does not include the United States. So here you're going to have Canada, Central America, South America. And finally, you have Asia Pacific and Africa. It is pretty impressive that United States alone makes up over half of the total revenue. So out of $20.7 billion of revenue, United States makes up $10.7 billion of that. The other $10 billion comes from international. Europe makes up close to half of that 10. $4.8 billion comes from Europe. $3.7 billion comes from Asia Pacific and Africa, and $1.5 comes from the Western Hemisphere. So now let's take a quick look just to see how that revenue has changed throughout the year. United States, compared to the same time last year, grew by 5.6%. Pretty impressive. Those are strong growth numbers, if I may say so. Europe also grew by similar digits, 4.7% in Europe. And these are the 2 biggest, right? Europe and United States make up close to 75% of the total revenue. So to have the 75% of the total sales increase by mid-single digits shows that there is still growth in this company. Then we have Western Hemisphere. The Western Hemisphere is pretty much flat. It lost 0.1%. To me, that's just that could be simply a rounding error. So it's very, very small loss there. Asia Pacific took a big hit and is down 3.1%. Overall, worldwide, like we said, it was a 3.3% increase in revenue, and that's what I mentioned earlier before. Again, I just wanted to show this company's financial highlights for 2020. GAAP earnings per share for Q1 was $2.17. For Q1 2019 was $1.39. So they were a lot better with their money this year compared to the same time last year. That's why we see that 56.1%. And adjusted earnings per share gives more realistic, right? Because if you do adjusted earnings per share, it takes away one-time expenses. So they might have had a big one-time expense in GAAP earnings per share last year, and that's why we see such a huge growth this year. But when we take a look at adjusted earnings per share, it takes away those one-time expenses and shows the true, what many say the true values. Last year was $2.10. This year was $2.30, an increase of 9.5%. So you can still see this company is still growing. Again, this does not mean that I'm a fan of adjusted earnings per share, but I think it's, as an investor, you should look at both. Obviously, I don't want to invest in a company that's giving me negative GAAP earnings per share. But if those adjusted earnings per share do make sense in what they're taking out and what are they removing, then I think it is good to be able to use both earnings per share. I know certain investors only like using GAAP. I know other investors only like using adjusted. I think I personally enjoy take a look at both. All right, so we already saw the revenue. We saw how the revenue was distributed between those three segments. Then we saw the revenue by region. And I now wanted to take a look at this company's income statement to see how this company is really doing. So this company, like I said, last year made $20 billion in sales. Pretty much flat, $20 billion. This year made $20.7 billion. So this was only a $700 million increase in total sales. But somehow this company, if we take a look here at net earnings, this company made about $2 billion more in net earnings than they did last year. And that's pretty crazy. That's why we see that huge change in earnings per share. And things like that you need to focus on, right? Because it's like you've only made $700 million more in sales, but somehow your earnings were up by $2 billion. So those are things one investor needs to take a look, and we're going to take a look at it today. So we can see, right, their cost of products sold did not decrease much. It's pretty much the same amount. So there was no change there. The biggest things here are research and development expenses and in-process research and development. So same time last year, this company used about $3.6 billion, 3.6, almost 3.7. Actually, it is 3.7. So $3.7 billion last year on some form of research and development. This year, they used $2.6 billion. So $2.6 billion now compared to $3.7 billion last year. So that's about 1.1 billion change. And that's where we see a huge portion of this company's earnings, right? So that now you add that back into the earnings, and we can see why there was a shift in the earnings. But things like this, I think it's always good to take a look at to see where the changes happen. Finally, this company has yet to give in their 10Q report, so there's no real balance sheet out there at the moment until they pour out their 10Q report. Usually companies, even after earnings, still take some time before reporting their 10Q report. But they did give us a bit of information of how their balance sheet looks like. So right now they have about $18 billion in cash and marketable securities. That's a pretty nice amount of cash. And they have a debt of $27.6 billion. So it gives them a net debt of about $10 billion, which is not too bad compared to the amount of cash and cash securities they have. So I don't think that's unreasonable to have. And then here they give us what their capital allocation strategy is. The most important thing is they want to continue to keep organic growth of the business needs. They want high priority on free cash flow, and lower priorities are investments, competitive dividends, and share repurchase. Just this quarter alone, they spent $2.6 billion invested in research and development, which we actually saw previously in the income statement. And they're doing $2.5 billion in dividend paid to shareholders. To me, sometimes as an investor, I'm not much of a dividend investor, so my mentality can be a bit different compared to those. But I would honestly prefer this company use its money more in researching and development, right? The healthcare is such an industry that I'm pretty sure you can continue to develop new items. And I think it's just a matter of how much cash you put on it. So for them to almost have a 1-to-1 ratio on research and development and shareholder dividend returns. Again, that wouldn't make me a fan of the company, but again, I'm not much of a dividend investor opposed to a company that's really trying to grow. Next, remember how we took a look at, there are 3 segments, and we saw the only segment that really took an impact was medical devices, that it was actually down close to 8% compared to the same time last year. They say that this is still bound to, it's going to get worse for the upcoming quarter. For quarter 1, they mentioned that this was the initial impact. For quarter 2, they expect a significant impact here in the medical devices. Remember, medical devices made up close to 25% of the total revenue. So they're expecting to see a bigger impact there. In quarter 3, they expect some form of stabilization. And finally, by quarter 4, they're expecting some form of recovery. And this is pretty much, I want to say this is the main reason this company is giving a down guidance is pulling their guidance due to this impact of the medical devices. And yeah, $5.9 billion of that $20.7 billion came from medical devices, and that was after an 8.2 decrease. So the medical devices make up over 25%. Close to 30% of the total revenue comes from medical devices. So they're expecting quarter 2 to be even worse. So they're going to definitely see a slowdown here. Finally, let's take a look at this company's guidance. So they still say for the long term, fundamentals remain intact. There hasn't been much change, but they do say in the short term for 2020, they had to lower their guidance to reflect the COVID-19 impact and related investments. So before this updated guidance, this company was expected for this year to have about a 4 to 5% growth in sales for this full year, for this guidance of 2020. They're actually retracting their guidance, and they're expecting a lot lower numbers. Instead of $85 billion, they're expecting somewhere as low as $77 billion, which would mean this company is actually going to lose sales somewhere between 5.5% to 2% loss. So they're still saying they're going to expect some losses for this upcoming year compared to the same time last year. All right, so the last thing I want to take a look at is forward PE ratio for this company. For December of 2021, this company is expected to make somewhere between $9.35. So that's 2 years from now. Right now, the company is sitting at $147, give or take. We divide it by $9.35. This gives this a company a forward PE ratio of 15.72. I'm not gonna lie, that actually looks pretty cheap, and if I am looking for somewhere to diversify, I might think Johnson & Johnson is not a bad place to do that. Some things I do like, right? They have a pretty great forward PE ratio. Their balance sheet is not that horrible. They have a nice amount of cash and not too heavy of a debt. We are going to see a decrease in their total revenue because of medical devices, but they are focusing on a COVID-19 vaccine, which if they do in fact do well with it, can lead to really strong potential gains for the company. Finally, this company does provide a very strong, healthy dividends that we saw here. Things I did not like though is because of that strong dividend. I do feel like this company can actually use more money in research and development, but then that's just my own understanding of how I like a company to interact. But given that 15 forward PE ratio, it doesn't look like bad for me, and it's something that I'm gonna think about if I should enter this market. So let me know, guys. Would you guys buy into Johnson & Johnson right now, even though this big gap up? Do you think that 15.7 forward PE ratio is still too high or too low for a two-year investments? Let me know in the comments below, guys. Have a good night and see you next time.